group of people. I'm Buddy Arnheim, and I am a partner in this firm. I co-founded our Bay Area offices, so thank you guys for coming over. And if you have any complaints about the hospitality, I'll send you to somebody else. I'll give you a little propaganda on the firm and a little bit about my practice, and then we'll jump into this conversation. So about the firm, we're a large multinational law firm. So about 900 lawyers, and multinational meaning U.S. and China. We have 18 offices in the States and 3 in China. The firm's celebrating its 100-year anniversary, and there's a great little story on our website that characterizes both our history and really how we prioritize the companies and the clients we represent. When our 2 founding partners were setting up their law office, they went to a new building in Seattle, and the landlord looked them up and down and thought, oh my, 2 lawyers, that's going to be my first tenant, not so sure. And at the same time, William Boeing walked in and said, I'm going to start an aeronautics manufacturing business. And I think the landlord had a similar reaction. Oh no, build airplanes. But the market wasn't that robust, so we put the 2 together, and we formed the Boeing company, and we've represented Boeing ever since. And that method of that ethos of representing entrepreneurs as they start their companies and grow them is really where we've been focusing for 100 years. And we've had the great fortune of working with incredibly courageous entrepreneurs and the investors behind them. Companies like Craig McCaw and McCaw Cellular, and Jeff Bezos and Amazon, and Craig Newbark and Craigslist, and a whole bunch of others, Startup Monthly, and Vadim and Yuri. So that's a little bit of the firm. In the firm, in addition to sort of founding these 2 offices in the Bay Area, our Palo Alto office and our San Francisco office, I also run our emerging companies practice, which is a group of lawyers that spend most, if not all, of their time working with folks like you. And we've got about 370 venture-backed companies that call us their outside general counsel, and several hundred other non-venture-backed but similar growth trajectory startups that we work with, as well as a number of investors. And I love what I do, and I love what I do mostly because I get to work with amazing people, and I get exposed to amazingly creative ideas and the courage to pursue those ideas. And it's so with that in mind, I think our primary goal as a firm is to figure out ways to help our clients be successful. And as I talk through this topic about how we help our clients get funded and how to structure the funding in particular, it's with an eye towards recognizing these are early stage businesses that are very risk tolerant, very cash constrained, and most importantly needing to move very quickly before that perishable market opportunity disappears on them or gets taken by somebody else. So we're going to talk about funding the startup. Again, my name is Buddy, and it is November 2012. I'm not the best PowerPoint builder, so some of this stuff is sophomoric, but be patient with me. So the first thing, and I wasn't here for all of Christine's talk, although what I was here for was exceptional, so thank you for that great information. So if some of this is repetitive, just kind of wave me off and I'll move forward. But generally speaking, the first question we get is, what are the funding sources? Where do I get money? And oftentimes the founders end up digging into their credit cards first. And Visa and MasterCard probably don't realize that they're the most popular seed financiers of startups, but they are indeed. And but more seriously, the first source of capital tends to be the friends and the family, the people that know the entrepreneurs, and are willing to take what is a high-risk bet on them. But very shortly thereafter, they'll look at other sources of capital, and we've got this capital of angels and super angels and seed funds, and it's all kind of blurring together. But generally speaking, this is a category of investors that are typically professional investors. They do this either full-time or part-time for a business purpose. And they tend to assemble a group of capital or assemble seed capital as a group. And I'll talk in more detail about that momentarily. Let me get the rest of the list out here. There's a new category that's kind of emerged over the last 24 months that we threw on here called crowdsourced funding. Kickstarter, does most people know about Kickstarter? It's, I think, phenomenally interesting. And we've had some of our companies be very successful in terms of raising serious amounts of seed capital through this mechanism. Particularly for product-oriented businesses or consumer product-oriented businesses, this can be a phenomenal way of raising some seed capital. And so far, it seems pretty safe. There are some legal issues that we could talk about in another discussion, but generally speaking, it's very, very exciting. Venture capital, which you just learned a ton about. Corporate, and I threw corporate up here as its own bullet because we have seen as an industry, the venture industry has compressed over the last decade. We've seen a resurgence of corporate venture capital over the last 36 months. And we're seeing, does anybody have any idea why? Christine, I don't know if you talked much about this. You did talk about it.
We just mostly talked about sort of how traditional venture funds are structured and like what that kind of means for the companies outside. We didn't get into the other sources.
Okay. What we've seen here, and again, this is probably somewhat repetitive, is in 2001, $110 billion was committed to venture capital. And in 2011, it was $18 billion. And you could pretty much draw a fairly straight line on a graph to show sort of how that industry has compressed. And there's a whole bunch of reasons for that, and I won't get into it. However, since the market crashed and corporations were able to kind of pull their belts tight and start improving their operations, we've seen a significant infusion of corporate venture capital. And there's a couple reasons for that. Well, traditionally, the venture capital category hasn't produced stellar results for their investors, except at the top decile or top quartile. Corporate venture is not necessarily only ROI driven. Intel Capital, I think, is a little different. I think Intel Capital does look very closely at its financial ROI. But a lot of corporate investors want positive financial ROI, but are really using corporate venture as a surveying mechanism, a way to keep their eye on the frontier. And so we've seen that in spades over the last 12 to 24 months. And the last report I saw was something like $6.5 billion assembled from June 2011 through June 2012 of new corporate venture funds farmed by corporations for the first time. So it's a lot of capital. Government grants, we don't see a ton of that, but it does exist. 4 or 5 years ago when clean tech was all the rage, the government was very supportive of providing grant money to certain clean tech ventures. And so
in Russia it's very common right now, and Europe kind of runs.
It is, it can be, mostly. And then from time to time we see other players coming in. We see private equity from time to time crossing over that blurry line between a true private equity deal and a growth stage venture deal. We've seen hedge money come in and out very aggressively, particularly in the market downturns. And then there's others that you can use your creativity for. So anyway, how many folks in this room, entrepreneurs, have raised capital from these sort of above my hand sources? Several of you guys. Great. Generally speaking, when you've raised money from angels and super angels, have they come in, I assume they've come in as a syndicate, that you've seen them grouped together. And that's oftentimes the way it works, is you'll meet with a bunch of these folks, and then eventually somebody will emerge as a potential lead. And then the question is, well, what am I buying? What am I investing in? And so that's what we're going to talk about, how to structure the deal. And I'm not going to go through this is just statistics, but one really funny thing. If you are interested in making fun of the venture community, take a look at this video offline. It's a video that was put together by a venture fund in Boulder, Colorado called the Foundry Group.
Oh,
and it's
Jason and Brad.
Yeah, Brad Feld. It's absolutely
fabulous.
hilarious. So if you guys want, we'll send this PowerPoint around if you want it afterwards. It's absolutely hilarious.
Can you play it now?
We probably could.
I was going to actually play it for them.
Do you want to?
So yeah, go for
All right.
it.
That'll give me a break.
A little bit of a light relief. They're fabulous, these guys.
Oh, there it is. I hate those eraser things. They're crazy.
I don't know. This is not my laptop, so okay. Now we got it. Can you guys hear okay?
Yeah.
Yeah, let me turn off the light. I was trying to plug in the sound to it.
That's the partner meeting at the end.
Can you turn the sound up a little bit? Or?
Let me see if I can plug it in. Let me pause this for a second while we're trying to get this connected, because the words are actually hilarious.
So Jason emailed me when they launched this and asked me if I'd share it virally. I think it was last year. And I just watched it and went into hysterics, and of course, you know, shared it as much as I could. It's just, they're so Jason is actually a musician, so.
They know this is going down just like this.
You know, I just want to tell ya, it's been great getting to know a little about ya. About you, and I wonder, should we be together? Should we commit to each other for today and forever? Hey, you've been on my mind. Been at least a few hours since I've seen your slides. Since I met you at the Rosewood, or was it South by? Time for us to talk about our future lives. I know you want me. I might want you to. Let's share your deepest secrets and find if I can trust in you. I like you, just maybe. You've got a clue. Meet my partners on a Monday. We'll see if they can dig you too. Cause I'm a VC, I'm a VC. I drive around the Korean, said I need all the sushi. I'm a VC, oh, who are you? Cause I'm a VC, I'm a VC. It takes more than PowerPoint slides to impress me. I'm a VC, oh, who are you? Hey, will you ever learn? It's all about the feelings, not the legal terms. When you mentioned NDA, I got concerned.
We don't sign no NDAs.
Don't wanna fall in love and then get burned. 23, I can't believe you think that's cheap. For a company you started with your dog last week. Let's back up, let's do bucks. I'll wear my favorite khakis. You can buy the lattes and we'll climb under the term sheets. Cause I'm a VC, I'm a VC. I'm the guy people stand in line to meet me. I'm a VC, oh, who are you? Cause I'm a VC, I'm a VC. Don't go with friends and family cause you complete me. I'm a VC, oh, who are you?
Series A,
I like what I see.
Series B, you're the one for me. Series C,
Doodaloo me.
Series D,
Starting to get cold feet.
Series E,
Oh no.
Series F,
Where's my IPO?
Series G,
Get low.
Series H.
Time to go home. Hey, do you feel it, baby? Because you know he sees I'm a definite baby.
That's between a yes and a no.
Sorry I've been gone, I've been a little crazy. At the end of the day, it's all about the Hamiltons, baby. I know you seem great. I love what you're debuting, but I've got so many other deals that I'm now reviewing. It's not you, it's just me. I've got so many wooing, like the Chinese knockoff of what your team is so good doing. Cause I'm a VC, I'm a VC. Can't take a leap without people who pitch me. I'm a VC, who are you? Cause I'm a VC, I'm a VC. With my wonder twin powers, no fucker can beat me. I'm a VC, who are you? Cause I'm a VC, I'm a VC. Stanford, Harvard, educated, even MIT. I'm a VC, who are you? Cause I'm a VC, I'm a VC. If find me, check out Facebook, LinkedIn, or tweet me. I'm a VC.
Thanks, buddy. Thank you.
You know, every
so
time I
much.
see that, I find something new in there.
Yeah.
They did a great job. All right, so you guys can look at the outtakes offline. Let's get to business. All right, so we're going to talk about how this money gets infused. So you've got prospective investors, and if it's a venture capital fund, they're going to probably have in their mind already the right structure. But when you're raising seed capital, it's not always like that. In fact, more often, the seed investor that shows interest may say, I like what I'm hearing, what are the terms? And so we're going to talk a little bit about the two mechanisms or the two structures we use to infuse seed capital and ultimately the trade-offs between the two. So there's debt versus equity. You're either selling stock, which is equity, or you're borrowing money, which is debt. And there are essentially four categories of terms that both of those structures entail or involve. There's the economic terms, which are probably arguably the most important. There's the control terms, which we'll talk about the difference between the two momentarily. There's information rights, and then there's resale, or maybe there's not resale. But it's generally those four categories of issues get fleshed out when you're structuring these infusions of capital. And then there's some nuances, and I'm going to leave this as a placeholder for now. We're going to come back to that when you guys have questions. And by the way, this does not need to be a lecture. Feel free to raise your hands as we go. But so far, good? Everybody good? Okay. So let's talk about equity funding, by far the more popular way of infusing seed capital into a business. Here are the economic terms, and I'm going to kind of go through them one by one, and then we're going to revert back when we talk about debt so we can compare and contrast a little bit. The first and the most important issue is the valuation. And valuation has a certain vernacular around it. A for pre, including a 10% pool. Anybody not know what that means? Yeah, I mean, sometimes it sounds like a foreign language. So a for pre, that means the value of the business before I put my money in is $4 million. And when I say a 10% pool, what I want is after I put my money in on that $4 million valuation, I want 10% of the company's capital to be reserved but unallocated for issuance in the future to employees and consultants and advisors. And I don't want to be diluted by it. So a simple example might be that for pre, 10% unallocated pool, and the seed investors are going to invest $2 million. So after the $2 million comes into the company, what's the value of the company? Hands? $6 million, right. And what is the value of the equity that's outstanding before the capital comes in? The value of the equity outstanding before the capital comes in. Nope. Anybody want to?
360 if you take no fees.
There we go. Did everybody follow that one? Actually, it's 3-4 before you take the ESOP, because the ESOP is going to have an implied value of $600,000 or 10%. So basically, there's currently outstanding, let's call it 10 million shares of stock. Actually, let's not make the math that difficult. Let's say that there is currently outstanding 3.6 million shares of stock. And I'm going to buy $2 million of this company at a $4 million pre-money valuation, including a 10% pool. So after I put my money in, the total value of the enterprise will be deemed to be $6 million. $2 million is attributable to my investment. 10%, or $600,000, will be imputed to this unallocated pool that we talked about, this 10%, because 10% of $6 million is $600,000. And then the remaining $3.4 million will be attributable to that 3.4 million shares that are outstanding. If it's lightly sinking in, that's enough for now. We can come back and do some of the scenarios. But so there's a vernacular on valuation. And oftentimes entrepreneurs will say, well, what should I offer up as a valuation? How do you come up with valuation? What is the right valuation for this business? And obviously, the more the better. But what we oftentimes do is tell entrepreneurs that valuation is more of an art than a science. And there's a few different ways. There's a few different methodologies that investors use in order to assess evaluation. One is, what's typical? What's the typical? What am I seeing with all my other deals? And that's highly influenced by what percentage ownership do I expect to have after I make my investment? And what kind of valuation after I make my investment is reasonable so that by the time the company raises the next round, there's a decent step up in valuation. So oftentimes, as Christine was saying earlier, an institutional venture capital fund will oftentimes target a 20% ownership at liquidity. That's their goal. They would like to have 20% ownership at liquidity. And they oftentimes like to enter into an investment with another co-investor, another what they call a two-handed deal. So if there's two venture funds that are targeting a 20% interest at liquidity, and they may need a little bit more to get started because they expect some dilution over time, all of a sudden you're selling 40 some odd percent to the new venture capital investors. And whether they invest $5 million as a group, 2.5 each, or $10 million as a group, 5 each, they're probably targeting the same ownership. And so you can see that the valuation gets, one methodology of assessing valuation is to extrapolate what percentage ownership they want and what would be a reasonable step up for the next round. So on that latter point, what would be an appropriate post-money valuation of my investment so that when the company uses the capital that I'm investing and achieves its milestones and goes out to raise another round of capital, it can justify a higher valuation than what I paid, and I will receive the benefit of that increased appreciation. And that's the second methodology, is to sort of say, you know what, if the post-money of this round goes over an 8 pre, we're going to have a difficult time raising our next round in 8, 12, 15 months at a higher valuation, unless the milestones are absolutely hit out of the ballpark. So I need to see the post-money of this round down more at the $6 million level. So that's the second methodology. So you got methodology, what are the other deals I'm doing? What's a seed deal? And oftentimes they'll ask people like us who see hundreds of these deals a year, what's a fair seed valuation? And I can share that with you guys offline. The second is, okay, what kind of percentage ownership do I as the seed investor want to have initially? And the third is, where is it okay to set the post-money valuation of this business so that the company has a reasonable chance of raising its next round at a step up in valuation? There are other valuation methodologies. There's metrics and ratios of revenue, but for early stage businesses, those are rarely applied. Sometimes what you'll do is you'll factor in the potential market value of a startup, and you'll extrapolate how many rounds of capital it'll have to raise in order to sort of be successful in exploiting that market, and then eventually get down to that seed valuation. But generally speaking, those prior 3 methodologies are the ones that are used. So valuation tends to be the most important. In terms of pool, I do include price and pool in valuation because at the end of the day, as we walked through that example earlier, that does influence what the value or the implied value for the equity that you as founders own. If it's 4 million pre, but it's a 20% pool, your implied value is not 4 million, it's less than 4 million, because 20% of the company is going to be reserved in this unallocated pool and diluted and used for future issuances and dilute you, but not the investors. Any questions on valuation? I know that was kind of a lot of information thrown at you quickly, but I wanted to get it out there. Second economic term is proceeds. How much are you raising? And in my experience, angel investors like to make sure that when they invest, there's enough money going into the company so that the company has a very good shot at achieving the stated milestones or the assumed milestones that are necessary to be achieved in order to raise the next round of capital. So proceeds tends to be very important, and oftentimes we'll see it structured that as minimum of 500,000, but up to 1.2 million or more if everybody agrees on more, something like that. The third economic term here is a liquidation preference. Does everybody know what liquidation preference is? Anybody not know it? Okay, so let me quickly state. Liquidation preference is a legal term, and it's really it's probably the most important economic legal term, and it's essentially downside protection for the company, for the investors. It usually is structured as how the proceeds of the company will be distributed to its stockholders if the company gets sold or goes out of business before it goes public, before it goes IPO. And there's a whole spectrum of ways that gets structured, but most often at the seed stage, we'll see it structured as what's called non-participating preferred, which means I, as an investor, either in the context of a sale of the company, get my money back, and that's it, or I convert into common stock and I share like every other common stockholder. And I'll make an economic decision right before that transaction transpires as to which is better for me. There are other flavors of liquidation preference. We don't see them as often in the seed stage, but at the other end of the spectrum is what's called full participation, in which I don't have to make the election. I automatically get my cost back, and then I share. And maybe I don't get just my cost back, maybe I get 2x my cost or 3x my cost. There's a whole range of ways you could structure it. But generally speaking, at a seed stage, we see liquidation preference structured in the most bland manner, which is this either cost back or I convert into common and get share like all other common stockholders. The next economic term is what's called anti-dilution protection. Price-based anti-dilution protection is the most popular, and basically what it says is, if I as an investor am coming in and paying $1 a share, I don't want you selling stock for less than $1 a share to anybody else unless I get adjusted. And there's a myriad of ways that you can structure that adjustment, and there's a myriad of exceptions to that rule. For example, the company is most likely going to be selling preferred stock to its investors at $1 a share, and it's going to turn around and issue common stock options to its employees as it hires people at 20 cents a share or 15 cents a share. And so that is a price per share lower than what I paid. That's usually okay. That's usually permitted and excluded from an anti-dilution protection mechanism. But if the company were to raise money from me at $1 a share and turn around and raise money from Yuri at 50 cents a share, I'm not going to be happy with that, and I'm going to expect some adjustment. And that adjustment could be all of a sudden I get ratcheted all the way down to 50 cents a share on my investment, or it could be taking a look at how much I own, how much Yuri now owns, and doing a weighted average calculation. So the true effect of the dilution is adjusting my economics, not an artificial one. So for example, if I bought $10 million worth of stock at $1 a share, and Yuri turned around and bought 1% of the company for 50 cents a share, I'm not sure I should be ratcheted all the way down to 50 cents a share. So it's the weighted average would take a look at my ownership, what I paid, his ownership, what he paid, and do a weighted average adjustment. Any questions with that? By the way, in seed deals, we oftentimes do see some price-based anti-dilution protection, this weighted average formula, but sometimes we don't even see that because the assumption on many seed investors is it's unlikely the company's going to raise money at a price per share lower than what I paid, and if it does, something terrible went wrong. So I'm not going to spend too much time engineering this. The next economic term is a dividend preference. By and large, we rarely pay any attention to this. These companies are rarely formed with the purpose of issuing dividends out to its investors. If there is any surplus cash, it's usually used to grow the business. So we don't spend too much time here. But what we do say is that if there ever is a dividend, the preferred's going to get it first, and then the common, just in case the dividend mechanism is used as a way of getting some cash out to the company, because the company is neither fish nor fowl. It's neither a huge success nor a failure. Last is this preemptive right. And the preemptive right is the right to participate in future financings. Oftentimes it's structured so that I have the right to at least maintain my ownership in the business. But sometimes I want to improve my ownership over time. I want to grow. The other things may not spend too much time structuring. And then equity financing, the next set of terms are the control terms. And we, us lawyers, we can go crazy with this stuff. We can put in place all sorts of kinky mechanisms to ensure control in lots of different corner cases. But at the end of the day, these startups are usually binary. They're either going to raise capital, achieve enough traction to go and then raise another round of capital or maybe liquidate, or they're not. And so we don't spend, and they're really very early stage. There's oftentimes a lot of unstructured behavior. And so we don't tend to spend too much time on control issues. But the things that do pop up from time to time, first, should the investors have board representation? And that's not that uncommon for an institutional investor to require. It's a little less common for angel investors to require. And usually the level of board participation is commensurate or proportionate to the ownership in the company. So if the investors are buying 10% of the business, they're probably not going to get a board seat. If they're buying 30 or 40% of the business, they probably are going to have a representative on the board. The next is these things, yeah.
How is the startup represented on the board?
How is the startup represented? With the founders, typically.
All the founders?
well, not all the founders. I mean, you might have a startup with 1 or 2 founders, and it wouldn't be uncommon for 1 or 2 members of the common stock class, i.e. the founders, to be on the board. But if there's 4 or 5 founders, it'd be very awkward to have that
So
many.
they choose.
Yeah. We have a company called Cloudera that was founded by 4 individuals, and they immediately raised capital right after they got the company formed. And we had to decide which 2 of the 4 we were going to put on the board, and they've actually done a little rotation with the founders. The next control term is what's called protected provisions, and these are rights that are codified in the company's governance documents, and they basically have a flavor of the following. If you're going to sell the company, you need a majority of the preferred stockholders to say yes. If you're going to create a new class of stock, a new preferred class of stock, when you go and raise your next round of financing, you need the majority of the preferred stock to say yes. And as companies become more mature, the granularity of the protective provisions tends to grow. But in the early days, there's really not a lot that investors typically require here. They might require a veto over a sale. They might require a veto over the next financing. They might require a veto if you're going to change the board composition. But by and large, they certainly will require a veto if you're trying to change their rights, the terms of their stock. But other than that, seed investors aren't terribly concerned about additional control. They're not going to invest if they don't already have some sense of confidence that the founders are going to do what they're telling the investors that they're going to do. We do at times get into a little bit of a negotiation here where we say, okay, we'll give you a veto on the next financing, but only if the price per share is not north of what you paid. If it's an up round, we really don't need your permission. You should be thrilled that we're raising capital at a higher valuation. Those are the kinds of things we sort of work through. But by and large, we don't spend in the seed stage. We don't spend too much time with these. There's also what are called negative covenants or even positive covenants, and these are contractual agreements that the company is making to the investors. We will make each of our employees sign the appropriate non-disclosure agreement. We will not encumber our intellectual property without your permission. It's those kinds of things. And again, by and large, in the early stage financing, we don't have too many negative covenants. And if we do, they're the ones that are very standard. Like we will not issue options to employees without a standard 4-year vesting schedule, something along those lines. And then this last control term is actually an increasingly important term, and it's called a drag-along. And does anybody know what a drag-along is here? Anyone want to share their wisdom? So the concept in a drag-along is that if the majority of the owners, if a majority of the preferred and a majority of the common stock want to do something, they want to sell the company, or they want to raise capital and amend the charter, the rest of the stockholders, the little guys, have to be dragged along. They have to say yes. So it ends up being a voting agreement. And the purpose of the drag along is to prevent small stockholders from being able to serve as holdouts. Prevent small stockholders from being able to extort the company at an inopportune time. In the United States, if you want to sell a company and have the acquirer merge the company out, buy all the company's outstanding capital stock, technically you need a majority of the stockholders to say yes unless you contract for something more. But practically speaking, no acquirer wants to buy a company if it has minor little dissident stockholders that are unhappy about the transaction. And there's actually something in the United States that empowers small stockholders to cause trouble and require a buyer to cash them out if they don't otherwise like the sale price. And so this drag along prevents that from happening. Basically keeps everybody in a nice tight container. Questions on control terms? Yeah?
What about tag-along?
Tag-along. Tag-along I'm going to get to in a moment. A little different concept, but it's generally more on the resale, and it does have a control mechanism. So tag-along are also sometimes referred to as co-sale rights, piggyback rights. And the idea is that if some stockholder, current existing stockholder, usually a common stockholder, is about to sell their stock before there's a liquidity event, the investors can tag along on that sale. They can piggyback on that sale. They can co-sale along. The idea being that the investors typically get the access to the first liquidity. And I'll talk about that a little bit more momentarily. information rights. So information rights are rights, usually contractual, but sometimes statutory, that investors have that the startup needs to adhere to. And again, in the early stages, we really don't see too much formality around information rights. I mean, typically these companies are not audited by accounting firms. They're usually pre-audit. They may not even have revenue. They may not even have really an income statement other than a cost schedule. And sometimes they keep their books and records fairly informal because they're early stage and they don't have a lot of legal resources. But by and large, if they do provide information rights, these are the categories. Financial. Give me some kind of periodic, maybe it's monthly, maybe it's quarterly, maybe it's annually, maybe it's all three, view into the P&L and the cash balance. And as the company gets more sophisticated, this will turn into actual audited financial requirement on an annual basis and unaudited on a quarterly basis and monthly budgeting, and maybe meetings periodically with contractual meetings with management. The second category is inspection rights. Under Delaware law and California law, a stockholder does have the right to require the company to open up its book and records to stockholders. And these usually do get codified, and they very rarely get exercised, but we do want to respect the law on it. And the last is board observers. We talked a little bit about the board in the control context, but this is more in the context of information, ways that seed investors or early stage investors get visibility into what the company's doing. Maybe it's because they're on the board, maybe it's they're invited to the board and are given the privilege of observing that discussion on a periodic basis so that they can stay fresh. So these are generally the information rights we see with an equity round. Any questions? And then the last category is, again, this liquidity or resale category. And I put down here redemption. And redemption is very uncommon, particularly here on the West Coast. The idea of a redemption right is that the investors at some specific interval in the future can require the company to buy their stock back, either at cost or at an agreed upon premium. And again, it causes all sorts of issues. I've been doing this for 20 years. I've represented literally over 1,000 startups. I've only seen redemption rights exercised one time, and it was as a lever point to try to get the company to do something else. So while investors may have a contractual requirement with their LPs that in 7 to 10 years they're going to liquidate their investment portfolio, and thus they may ask for redemption rights, they rarely mean anything. And again, on the West Coast, I think by and large we don't even bother codifying them, with some exceptions. The other liquidity mechanisms here are rights, registration rights. In the United States, if you want to sell your stock, that stock either has to be registered both at the federal level and at the state level, which is a really expensive, cumbersome process, or you have to find an exemption. And so in the early days, we find exemptions to sell to investors and to issue stock to employees. But in the later days, when they want to go public, you have to go through a registration process. And registration rights are a contractual give by the company to the investors that say one of three things. Hey, at some interval, 5 years on the road, you can require us to register the stock and go public. Or, hey, if you're already going public or already public and you're going to register some stock on behalf of the company, register our stock, the investors. It's called piggybacks. Or you're already public and there's already a float out there, but it's easier for us to sell stock through a registered mechanism as opposed to in the secondary market, private secondary market, or through an exemption. Registration rights, again, very rarely negotiated. Most people understand what they are. And again, having done this 20 years and worked with lots of different companies and investors, these rarely get exercised. They're just one of those things that we don't waste a lot of time negotiating, but they are in there because there is some utility down the road theoretically. And the last gets back to your question on puts and the tag-along concept. So we've seen in the last 3 to 4 years an increase in secondary liquidity before the company itself, the startup itself, is liquid. And that secondary liquidity has arisen because there are things like second market and shares posts that are creating a secondary market for these private securities to be sold. it's because there are some new funds that have been established that invest in secondary instruments. Industry Ventures is one that you may have heard of. Saints Capital is another. And by and large, it's taken longer for some of these companies to get liquid. And as we all know, employees and particularly founders of these startups tend to not be cash compensated as richly as they might be if they were to go to a more established business. So they work 6-7 years on anemic salaries, want to buy a house, want to pay for their kids' tuition, and it's nice that they can take a little bit of money off the table. And from a VC's perspective, doing so, allowing them to have some liquidity, might align their interests better with the VC's long-term goal, which is to hit a home run, to go for the billion-dollar molecule. And if a founder who doesn't have much net worth is able to put a couple $1 million in his or her pocket and then have the right incentives to go for the big IPO, the investors are generally copacetic with that. So we are seeing mechanisms put in place, not very often in the seed stage, to allow founders or employees to be able to put their stock in different directions, maybe back to the company, maybe to existing investors, maybe to an authorized secondary buyer. However, if there's too much liquidity, and this gets back to the tag-along, the investors may not be comfortable. They may say, you know what, we invested. If there's going to be any liquidity other than a modest amount for you, the founder, we ought to have access to it, unless we sometimes put in place this tag-along concept. Anyway, so this is a lot of information about equity financing. For purposes of this conversation, I think most of us are focusing on the earlier stage investments. And while all of this comes into play, in the early stage investments where you're raising $1 million, a couple $1 million, the goal is to not necessarily perfect all these rights, but to have enough in place so that the investors are protected, but so that the deal itself doesn't take too long to close, doesn't cost too much money to paper, and doesn't create issues for the next round of financing. Doesn't look weird so that the future financiers are uncomfortable with the cap structure. So that's equity. So far, so good? All right, let's move on to debt financing. So again, we have the same 4 categories, but in a debt financing, the number of terms that we structure tend to be thinner, lighter. And so generally speaking, we see that when startup companies are raising $1 million or less, they tend to bias this debt structure. It's easier to paper, takes less time to close, and by the end of this conversation, I'll hopefully convince you that it provides almost all the same protections to investors. But let's go dig through the economics. So in a debt financing, the economic terms include the conversion discount. The idea is I borrow money, I, the startup company, borrow money from investors. I don't set a valuation per se today. I'm just going to borrow your money. But I'm going to promise to let you convert that money into the next round of financing, the equity round, at a discount. So that while I'm using your money today, and we're not locking the valuation until tomorrow, you're going to get some of that appreciation. You're going to share in that growth of value by getting a conversion discount. So if I borrow $1 million from you, and I give you a 20% discount, you'll convert that $1 million into the next round at a per share price of 20% less than what the investors in that next round are buying. And that's the juice. That's what I'm giving you as a benefit for putting your money in today. Some investors say, great. Most say, yeah, I don't really love that because I've seen Airbnb close their Series A at a $6 million pre and close their Series B at a $1 billion post. So I didn't really like a 20% discount for giving you the value of my money to create, $900+ million of value. So instead, I'd like to set a valuation cap on the conversion. And so how about this? I'll convert it the next round at a discount of 20% or an enterprise value of $6 million or $10 million, whichever's lower. And that's by and large how these things tend to get structured. Sometimes we see equity kickers. Equity kickers are usually warrants. Warrants are analogous to options. They're the right to purchase more stock in the future at a specific price. Our general, as lawyers that are trying to keep our fees under control, we generally discourage the issuance of equity kickers if the round is $1 million or less. It's just another piece of paper that has to be negotiated. And offline, I'd be happy to prove to you that a conversion discount equates to the same economics as an equity kicker if structured the right way. Sometimes, in the very rare instance, a company will borrow money from its seed investors, and before the next round happens and that equity, that debt can convert into the equity, the company gets bought. Very rare, but it does happen from time to time. And so oftentimes in the economic terms, we'll codify the repayment of the debt plus a premium if the company is bought before the debt converts into equity. And oftentimes that'll be structured, at least in these seed bridge deals, as a 1 or 2x premium on the principal. So you'll get your principal back, you'll get your interest, and then you get 1 or 2 times your principal on top of that. And the message is, without that money, the company would not probably have been in a position to sell itself. So here's a nice handsome return. Last is preemptive rights. It's the same concept. Many investors do come into a seed round and want to at least preserve their ownership going forward and maybe even grow it. So we sometimes codify a preemptive right. Yes?
I was just going to throw a comment in. So I don't want to say most venture capitalists, but most that I work with, which is maybe different, don't like convertible notes compared to equity. And there are a lot of reasons not to, but I know a couple of ones that you might care about are, number one, even with caps on conversion valuation, there's a little bit of at odds that this can put the VC and the entrepreneur where, especially if it's a high cap, like I see some of these companies, some accelerators, I'm not gonna name any, they come out and they have this $20 million cap on conversion, and I look at that and I was like, I don't want you to hit your cap. I'm rooting for you to have a low valuation because I don't have equity. And if I have equity, then I root for a high valuation. And so you have this strange disconnects, in incentives between the entrepreneur and the venture capitalist, which I think is bad. Like, and many other VCs I work with also think it's bad. Like, they think everyone should be on the same side of the table. So it's some weirdness about it. Or some of the accelerators that don't put any discount onto the conversion. And when there's no discount on conversion, I have zero reason to invest today. I'm just going to wait.
Yeah, that's right.
So.
Because the company will use your money, grow value, and you want to
So there's no guarantee that you get to, put more money in at the next round. And so, in fact, there's patterns of behavior that show that, in fact, the person who leads the next round often was not on the note. So there's really no benefit to being on a no discount note. So there's a lot of weirdness about it, and it's better than nothing, and it is faster. But there are you take some baggage with it.
Great points. We'll revisit a little bit more of the contrast between debt and equity as we get through this, but it's great points. The next category is information rights. By and large, in these seed bridge deals, we don't really memorialize much in the way of information rights. The investors are not equity holders, so they don't have those statutory inspection rights I talked about earlier. And we rarely spend time papering the right to receive written financial information. More sophisticated investors that participate in the bridges may require a covenant that says, hey, send me your monthly financials, your monthly P&L, and your annuals and your quarterlies. But generally speaking, information rights to bridge lenders is from a legal standpoint pretty sparse. From a practical standpoint, startups are oftentimes looking at their existing investors as folks that will help lead them or participate in the next round, so they tend to be, at least they're encouraged to be pretty open with their investors. But again, we don't spend too much time codifying information rights. Doesn't mean you can't. Control. There's also, generally speaking, very little in the way of written or contractual control by lenders in these kinds of financings. That being said, we do see from time to time some of those negative covenants that I talked about for an equity deal memorialized in the bridge financing. So at least there's some safeguards. But it is, at the same time, in the United States, when a company liquidates, debt holders are taken care of first. If there's any residual value in the entity, debt holders get that first, then equity holders. And so there's maybe a psychological sense that some of this control is baked into the fact that they own debt. These companies are early stage businesses. They rarely have residual value if they don't make it. So that is more theoretical than practical. And liquidity, we typically don't spend too much time codifying liquidity mechanisms like registration rights or co-sale tag-along rights. Those usually get memorialized when the debt converts into equity, and it typically shares the same liquidity type mechanisms that the investors in the equity round share or enjoy. So just to put some hard data in your minds as entrepreneurs and prospective investors, when we looked at the 180 seed deals we did in the first 6 months of this year, the legal fees that we generated or that opposing counsel generated tend to be about 25% for debt versus equity. So the equity rounds tend to be almost 4 times more expensive to paper and negotiate than the debt rounds. Now, there is big variability in that, but just generally speaking, they are profoundly less expensive if structured the right way, particularly in the very early days. The timing, equity rounds, we can and we try to close them in 2 to 3 weeks, but it's oftentimes 30 days. Debt deals that we've closed them in 2 days. So again, it's the speed to closure, and that's why by and large we will try as company counsel, and even sometimes as investors counsel, and I'll talk to Christine's point in a moment, to structure the sub $1 million raises as a bridge financing, as a debt financing. Just because it's so much quicker and the fees don't take too much away from the proceeds being raised. On Christine's point, I think the alignment of interest with the entrepreneurs in the company and the seed investors is critical. There's so much work that has to be done for a startup, and all hands rowing in the same direction makes a big difference. I think on the valuation alignment, there are ways to mitigate that tension by having the cap be lower and more realistic with where the investors see the valuation today. And so while it would be utopia for an entrepreneur to raise capital with no cap and have it be debt accruing very modest interest, realistically when you raise capital, in hindsight will be very prudent to raise it at a valuation that people feel is fair. Anyway, that's about the size of it. Any questions on, I'll get to that in a moment, any questions on debt versus equity and some of the major points to think about? Yeah.
So just to interrupt, we actually only have a couple of minutes.
Okay.
We need to wrap this up. I'm so sorry we've been running late all day, so my apologies, but go for it, Kathy.
I was just going to say, Freddie might want to just explain how you deal with the equity pool for the entrepreneur, the option pool in both of those situations.
Okay, fair point. The question was, how do you deal with the option pool in both of these structures? In an equity structure, it's oftentimes negotiated as part of the valuation. Like we talked about earlier, you'll have a $4 million pre, including a 10% unallocated pool, post money. And so that gets factored in, and that means that that 10%, when and if it gets issued by the company, will essentially be dilutive to the common stock, to the founding team, the common stockholders that were in existence before the company raised capital. In a debt financing structure, it really doesn't matter because ultimately that debt is going to sit on top and not translate into equity until you do that next round of financing. And when that next round of financing comes to fruition, the investors are likely going to negotiate an unallocated pool that gets earmarked at that next financing. And the debt will oftentimes convert and be included in, well, it will be converted into that round. Whether it gets included as new proceeds that sits on top of that pre-money or gets considered old money or already existing capitalization is up for negotiation. And that may be where you're sort of where your question lies. Let me try to explain that. I don't know if I have enough time to truly dig into that one. If anybody is interested in that, let me take that one offline and talk you through it, because the math on it is a little hard to just articulate without writing it down and walking you through it carefully. Okay.
Thanks,
That's it.
buddy. You've been
Thanks,
great.
guys.